This meeting is being recorded.
Great. Hello and welcome back to Principles of Accounting 2. I am still your host, Dr. B. We made it through that first week. We made it through the first week. I appreciate all of your effort in trying to get that LinkedIn Learning Certificate done by Sunday night. It was due this past Sunday night. I know that some of you may have joined the class a little bit late and maybe didn't have access to everything right away. I totally understand. I get it. So, and it's okay. Don't worry. But I want you to know that the LinkedIn Learning Certificate it's still due. You still need to do it. Just because you weren't here last week doesn't mean that you shouldn't do it. You need to do it because it's graded. And also, it's important to know that the way that attendance is tracked and reported to the university in this course is by your completion of the work. If you don't complete the work, you technically weren't here. You didn't do it, right? So really, really important that you do that because otherwise, it could potentially affect financial aid or anything like that. So really, and I don't want to see you be withdrawn from the course for that reason, you see. So really, really important that we get that done if you haven't already. I know that last week was really short. The semester started on Wednesday instead of Monday. So because we lost those 2 days, we had a really short week last week, one from Wednesday to Sunday. We had our first lecture last week on Thursday. I know that some of you joined the course late. Okay, so what does that mean? In the classroom, under the announcements, you probably saw, hopefully you are reading the announcements, but we had the welcome to week 1, and I also posted the recordings for week 1, yeah? The recordings was a recording of the first week, yeah? So please take a look at that if you haven't all done so already. Here we are in week 2. We're getting underway now. And so in the classroom, a couple of things. The textbook situation has been resolved. If you were having issues accessing the textbook before, that problem has been fixed. You'll be able to go to your course materials, click on the Brightwave materials, and it should open up like this. The textbook should be right here. It looks just like this. If you might need to log in or do some stuff in order to get there, but you'll get there, I promise. You'll be able to access the book there. If you're still having trouble with the textbook, please send me an email right away. I'll get you in contact with the bookstore manager, and we will get that issue resolved as quickly as possible. The other thing is, if you have not yet completed the LinkedIn Learning certificate and you have not yet activated your LinkedIn Learning account, that information is also under the Start Here menu. It says LinkedIn Learning Activation Instructions. You'll follow the 9 steps, or you can watch the video and follow along there to activate your account, and then you'll complete your LinkedIn Learning Certificate. That was due this past Sunday, and that is also how I report attendance to the university. So please make sure that you get that done as soon as you possibly can, because I'm pretty sure I need to report attendance at the end of this week. So let's get it done. Okay, and then last week, how you accessed your LinkedIn Learning Certificate is you went through here, you got to your Engage and Explore, you opened up your LinkedIn Learning Certificate training here. You probably had to do some logging in, and it started to play. You went through all of the videos. They all had the green check mark at the end of them. You got your certificate by going down here, certificates. You downloaded the PDF and you uploaded it to Action Expression. So that's what the process you should have followed if you were in class last week. If you weren't, the recording of that video is in the announcements. So that was last week. That was the first week. Here we are in the second week. Today, we're going to be talking about how to analyze the financial statements. This might take some recollection of Principles of Accounting 1. I know that some of you might be transfer students, And so you may have taken Principles of Accounting 1 at another institution. So this chapter helps to bridge Principles of Accounting 1 and Principles of Accounting 2. To access the materials, first you go to Week at a Glance, read through that. The next is go to your instructional materials and select this instructional materials link, and you will see the PowerPoint presentation, which we're about to cover. You can download it, make notes, and whatever you want to do with it. There's some additional information below, a couple of short YouTube videos that go over what we're about to cover, kind of reinforcing that information. And then for this week, we got a couple of things going on. We have a week 2 discussion board. The week 2 discussion board, your original post for this discussion board related to this chapter, your original post is due on Thursday night. Due on Thursday night for your original response. And then you'll reply to 2 of your classmates by Sunday night. The original post should consist of 150 words on average. And your 2 responses to your 2 classmates should be about 100 words each. If you write 1 sentence, you will get no credit for that response. Okay? If you write 2 or 3 sentences, you will get very little credit for that response. Okay? We're looking for full, substantial responses. Lena, very well done. This is a nice, full, substantial response. This is exactly what I'm looking for. Leland, excellent work. Full, substantial response. Now, Lisa, excellent job. This is a full, substantial response. When you reply, Leland, you did a wonderful job in your reply to Nalisa. Leland has an awesome, substantial post here as a response. So please look at what your classmates have done already. This will give you a great idea of what needs to be done in every single discussion board, okay, in order for you to earn full credit for that discussion board. So this week we have week 2 discussion board, and we also have a chapter 17 quiz. The thing with quizzes in this course is that you have 2 attempts. The higher of the 2 attempts will be accepted in the gradebook. What that means is if you didn't do so well on that first try it again. The higher of the 2 grades will be accepted. They're open book, open note, there's no timer. Okay, those are the quizzes. You'll also notice on our engagement explorer, there's this thing called Excel exercises. Exercises are just for practice. Exercises are just for practice. You do not need to complete these or submit these. These are just for your practice. Okay, just for practice. They do not get submitted for grading. Okay, just for practice. These are in pretty much every week. It's just to kind of help you get familiar with using Excel and also some hands-on learning experience. Having said all that, for week 2, let's go ahead and jump in to our presentation on financial statement analysis. And I'm going to go through this in a very logical way and explain everything, use some examples, and maybe even have a little fun with it. So here we go. We're going to talk about the financial statements that you remember learning about back in Principles of Accounting 1. The income statement, balance sheet, statement of cash flows, and statement of retained earnings. Those are the financial statements that we learned about how to build them up and create them back in Principles of Accounting 1. Now here we are transitioning into Principles of Accounting 2. We need to understand what type of information as a manager do I need to look for in those financial statements? Meaning, how do I analyze them? So I'm going to teach you some ways and methods to analyze those financial statements. So first, we have to think about why we analyze financial statements. The reason why we do it is because as a manager, I need to understand what is the prior performance and current performance of the company. How is the company doing today, and how did it do last year, and the year before that, and the year before that? And I make comparisons, to understand what are the trends of my company. How's my company doing? I also look at the current financial position of my company by analyzing the financial information from the income statement, balance sheet, statement of cash flow, statement of retained earnings. What's my current financial position look like? How well is the company doing today? And the third reason why I analyze financial statements is to understand the future performance and risk. What's the direction my company's heading in? And how do I mitigate risk along the way? Now, who cares about financial analysis? Who cares about this? Well, there's two groups of people that care. There's the internal users. Those are the managers, company officers, internal auditors, people working for the company. They care about this information. Then we have external users that also care about this financial analysis. The shareholders. As a shareholder of a company, I love knowing how that company's doing. And I compute ratios. I look at horizontal and vertical analysis to get an understanding of how the company's doing. The lenders care. They want to know what's the debt ratio before I lend more money to the company. Can the company pay me back? I also want to know, the suppliers also want to know how the company's doing. Why? Because if a supplier wants to allow the company to purchase inventory on account or on credit, got to make sure that they can pay us back. Okay? So that's why it's important to analyze financial statements. There are 4 building blocks of analysis that we look at.
The night that I found
The first one is called liquidity and efficiency. Can anyone tell me in the classroom today? Who can tell me? What does liquidity mean? What does it mean to be liquid? I don't know this.
How fast you can turn it into cash.
Yes, Ty. Very well done. Very well done, Ty. Yeah. The idea of liquidity is how quickly I can convert stuff into cash. And the reason why that's important, Ty, is because if I need to make a business decision to, I don't know, pay down debt or to maybe expand the business, I got to be liquid. Yeah, very well done. The next one that I typically look at is what's called solvency. What do you think? What does it mean to be solvent? Any idea? What does it mean to be solvent? Solvency. What do you think? Any ideas? What does it mean to be solvent? You've heard this term before? I don't know. What does it mean to be solvent? No guesses?
Yeah, Professor, I've never heard that term before. I'm not going to pretend I have.
Okay.
No.
I've heard of them, but not in
This-
account.
Right on.
Can you hear me?
Yeah, I can hear you, Michaela.
Like, it's like basically like when you pay like your stuff on time, right?
Yes. Yeah, very well done, Michaela. Absolutely right. So solvency. It's the company's ability to repay its debt. Company's ability to repay its debt, solvent. The definition is the company's ability to go out of business successfully Solvent. Solvent. In other words, does the company have enough assets to cover all of its liabilities? Is it solvent? Does it have the ability to repay its debt? Oh no, don't feel stupid, Leland. A lot of people haven't heard that term before, so it's all good. A lot of people haven't heard that term before. Solvent. Some people might think, oh, is it cleaning a stain out of the carpet? Solvent. No, different kind of solvent. Okay. Profitability. What does it mean to generate a profit? It's profitability. What does that mean? Any guesses? What is profitability? I know you all know this one. Leland.
I mean, yeah, just the ability to generate money,
Yeah,
basically.
basically.
Generate profit.
Generate profit. Well, how do I do that, Leland? How do I generate a profit? What's the process? What do you think?
I guess it means to make your whatever you're trying to sell attractive, so that way people will want to buy it.
Yep, yeah, that's part of it. And I got to make sure that what I'm selling covers my expenses.
There's a market for it. Yeah.
Yeah.
Okay.
Market for it, and it covers my expenses. So I think about what I'm selling, how much I'm going to sell it for.
Oh, if it covers the cost.
And it doesn't cover the cost. Yeah, exactly. And as long as it covers the cost, it's profitable.
It's profitable.
Yeah.
Okay.
In most cases. It gets tricky, you know, unless you're Peloton, then maybe not as profitable, but you know, that's a time for another story. Yeah, that's profitability. And then the last one is called market prospects. Market prospects has to do with the market, the share price of the company. There's an example of market prospects. We'll cover all these in detail, but yeah, that was a good exercise. I just want to kind of get a feel of where everyone was at, and you know, on these topics as we jump into them. Okay, so when I analyze the financial statements, I got to gather some information to be able to do that. What do I need? I need the income statement, balance sheet, statement of owner's equity, and the statement of cash flows. And I also need some notes. Who remembers what's on the income statement? Do you remember what is on the income statement? What's on the income statement? What are the two categories on the income statement?
Asset and liabilities.
No, not on the income statement. That's on a different statement. Think about the name, income statement. What's on it? You don't remember?
Oh, revenue and expense.
Yes, thank you. No, Lisa, you got it. Yeah, you were on the right track. Yeah, revenue and expenses, correct. Yeah, so on the top of the income statement, we got our sales, our revenue, and then minus cost of goods sold equals gross profit, minus all of our expenses equals net income. So yeah, that's our income statement. Very well done. What about the balance sheet? Now Lisa, you already got two of them on the balance sheet. What are the three items on the balance sheet? Three categories on the balance sheet. What are the three categories on the balance sheet? Who remembers? Now, Lisa.
Including the asset and liability.
Asset, liabilities, and what's the third one?
Expense.
Equity.
Owner's equity.
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 Yeah,
Equity.
yeah.
Yeah, very well
Owner's
done.
equity.
Yeah, equity. Yeah, assets equals liabilities plus equity is the accounting equation. The balance sheet represents the balances of assets, liabilities, and equity. They represent the balances of all the accounts that are asset accounts, liability accounts, and equity accounts. That's the balance sheet. Very well done. And then the third statement is called the statement of stockholders' equity or owner's equity. This represents changes in the owner's equity. Statement of owner's equity represents changes to equity. Okay, so what is on there? We have net income plus any investments from the owner into the company, minus owner's withdrawals equals ending balance owner's equity. Okay, that's on the statement of stockholders' equity. And then the last of the four financial statements is called the statement of cash flows. Anyone remember the three types of cash flows represented on the statement of cash flows? Anyone remember those three categories of cash flows on the statement of cash flows? It's might have been a while. Leland.
Oh, I was gonna say, I remember investing. I feel like I gotta go back in my old notes.
You're there.
But,
That's one of them.
okay.
You're there.
Yeah, don't ask me for the other two. I help.
It's all
I
good.
got.
It's all good. Okay, yeah. So I'll help you out. So the first category is called operating activities. This is represented cash coming in minus cash going out of the business for the day-to-day operating activities of the business. Then we have investing activities. This is the purchase or sale of property, plant, and equipment, cash coming into and out of the business for those reasons. And the third category is called financing activities. This would include things like the business taking out a loan or repaying a loan, issuance of bonds, and now the business and the difference in stock. So those are the categories: operating activities, investing activities, and financing activities. Very well done. Yeah, I like to go through that exercise to help to remind you of those financial statements, because it might have been some time the last time you had, no worries, Michaela. It might have been some time since the last time you had Principles of Accounting 1. It might have been a few months ago, or it might have been a few years ago. So, but yeah, I just want to go through the exercise with you to remind you. Okay, when we analyze the business, I look at this to help us to understand where our company is today in comparison, to help us to establish benchmarks. Okay, I look at my company in comparison to itself. I look at my company compared to my competitors. I'm looking at benchmark. I'm benchmarking myself, trying to understand how am I doing compared to my competitors, or how am I doing compared to my industry that I'm in, or based off of guidelines that I have. I think about like Coca-Cola comparing themselves to Pepsi, or Apple comparing themselves to Samsung, or Intel comparing themselves to AMD. Right? So these types of comparisons are really important for the business. In order for me to analyze the financial statements, I need to use some tools to be able to do that with. And there's three basic tools that I use to analyze the financial statements. The first of those tools is called the horizontal analysis. In a horizontal analysis, I'm looking at the financial performance of my company across time, from year to year. I'll look at my annual performance for 2023 and compare that to my performance from 2022 and 2021. The reason for that is I want to see the changes across time. Are my sales getting better? Are my expenses going up? What are my balances doing over time? You see, I'm looking at the changes across time. Horizontal, I'm looking across time, horizontal. The second tool I use to analyze financial statements is called vertical analysis. I'm looking up and down my income statement and balance sheet to understand the percentages off of a base amount. For example, on the income statement, I express everything as a percentage of total revenue. So for example, I would say, what percentage of my total revenue comes from cost of goods sold? What percentage of my total revenue comes from my rent expense? What percentage of my total revenue comes from my wage expense, etc.? See, that's vertical analysis. I'm expressing everything as a percentage, and I'm comparing that to my base amount. And the third tool is called a ratio analysis. And y'all remember ratios from Principles of Accounting 1, I'm sure. It probably drove some of you a little crazy computing some of those ratios. Examples of ratios will be things like the current ratio and the debt ratio and et cetera, et cetera, et cetera. There's a ton of different ratios, you know that. But those are the three tools that we have at our disposal to analyze financial statements. Now I'm going to walk through each one of these in a little bit more detail with you, starting with horizontal analysis. As I mentioned, horizontal analysis is when we're looking across time. On our income statement, I usually look at about 3 years of data, 2023, 2022, and 2021. Sometimes longer. It depends on the reason for looking at these trends. The idea here is that I'm looking for trends, changes in the dollars and the percentages, to get an understanding of where I need to improve the business. That's why we do horizontal analysis. Now, how do we compute horizontal analysis on our income statement or balance sheet? We use this very simple formula. To find the dollar change, we take the analysis period amount minus the base amount. The base amount is typically the oldest data that you have available for your analysis. So, for example, if I'm trying to understand 2023 and the changes in 2023, I'm going to take the amount from 2023 and subtract that from the amount I have from 2021. That gives me the dollar change from the base amount. Base amount is typically the oldest data available for the analysis period. So that's the first thing we do is we find the dollar change. The other thing we do is we find the percent change, because I want to understand the changes in both terms of dollars and percentage. To find the percent change, we take the analysis period amount minus the base amount divided by the base amount times 100. I'm going to take my 2023 amounts minus my 2021 amounts divided by 2021 amounts times 100. For example, that's if we have the 3 years of data. In some cases, you might only have 2 years of data. For example, on the balance sheet, we typically only have 2 years of data on an annual report. We have the current year and the prior year. So I'll do this for current year and prior year on the balance sheet. So here toward the bottom, we have a very quick and easy analysis. Case A, analysis period is 1500 minus the base period 4500, gives me dollar change. I could figure out the percentage by taking 1500 minus 4500 divided by 4500 times 100 will give me my percent change. Well, let's look at some actual data to help us to put this into perspective. When doing a horizontal analysis, I'm looking across time. So here I have 2 years of data. I have the current year and the prior year. And I do this for both the balance sheet and the income statement. First, I find the dollar change. I take the current year minus the prior year. Simple. That gives me my dollar change. For example, let's look at total assets. Maybe not a great example. Let's look at the cash amount. Okay, 48,844 current year minus the prior year, 25,913. That gives me a dollar change of 22,931. Now, what about percent change? How do I get that? I take the current year minus the prior year divided by the prior year. So in this case, I would take 22,931 divided by 25,013, and then I would multiply that by 100 to get 88.5%. And you can see that I do that for every single line item. I'll tell you that the easiest way to do something like this is in Excel. Okay, Excel is your friend when it comes to stuff like this. I could just drag and drop that formula, be done in a matter of 2 minutes. If you try to do this by hand, it'll take you a couple hours. That's why Excel's nice and easy for this. But I'm just trying to show you, for all intents and purposes, of how we analyze using horizontal analysis. So this is on the balance sheet. I do the same exact thing for the income statement, for each line item on the income statement. So here we have an example. We'll take total operating expenses. Current year, 34,462. Prior year, 30,941. That gives me a difference of 3,521. I take 3,521 divided by 30,941 equals, or times 100, equals 11.4%. You see? I get dollar change and percent change for every single line item on both the balance sheet and the income statement. Same exact formulas. You see? Now that I know what that is, now I can look even further. I can look deeper into the data. So when we have multiple years, instead of just 2, let's say I have 5 years. Okay. I have 5 years of data. I can do what's called a trend percentage. I take the analysis period amount divided by the base amount, and I multiply that by 100. Trend percentage. And to show you what that looks like, here I have 5 years of data. The current year amount, 260,174, minus the base amount, 233,715, back in 4 years ago. Divided by that base amount gets me a percentage of 111.3%. It gives you an idea. Yeah, gives you an idea. And the reason why we do trend analysis is to understand what the trends are across multiple years. And we can graph that. Also, you could do this in Excel nice and easily. Graph helps us to visualize what's happening in the trends.
Professor, oh, I'm sorry, I don't mean to interrupt, but the last slide you had, it was 4 years ago. At the 4 years ago, it was 100%. Was that because that was when it started? So I guess everything starts at 100%, and then it goes up and down.
You got it. So okay. Well, the reason why it's 100%, Leland, is because the base year is 4 years ago, and so because the base year is the oldest data that we have,
it always starts at 100%.
Yeah, well, it's something divided by itself. Right? So,
great.
So 233,715 divided by 233,715, that's 100%.
Yeah, it's 1.
Yeah, 1.
Yeah, okay. Got it.
Yeah.
Got it. Okay, I was just, okay.
Yeah, great question. Thank you for asking it. Absolutely. Very well done. Yep, and then so we can visualize things, just helps us to understand things a little bit easier. And the great thing is with today's technology, We have a lot of tools available. Like, for example, I don't know if any of you have ever had the chance to use Power BI, but you can create data dashboards with Power BI. You do the same thing in Excel. And, when you're trying to explain financial data to non-financial people, the best way to do that is through charts and graphs, because it just makes it easier for them to understand what's going on. Yep. Charts and graphs. I had a couple of clients that didn't quite get accounting, so I had to explain through charts and graphs. And, they get it. They start to get it because they get the visuals, but they don't always get the numbers. So we talked about the horizontal analysis, looking across time. Now let's talk about vertical analysis. The reason why we look at vertical analysis is we want to understand everything as what we call a common size. We analyze our income statement and balance sheet expressing it as a base amount in order for us to understand the common size. We try to make it relative to itself. Yeah. The only reason why I would do something like this is if I'm comparing my company to my competitor, I want to be able to put us on an even footing. For example, Marriott hotels and Hyatt hotels, okay, they report differently. They have similar income, they have similar expenses, they have similar items on their balance sheet, but they report differently. Marriott expresses everything in their report in millions. A lot of commas, a lot of zeros. Hyatt expresses everything in thousands. So you're thinking to yourself, well, I got two different pieces of data. Two companies report differently. I'm looking at these two competitors. How can I make it fair? We do it through this process called common size financial statements. We express everything as percentage. And that's how we can compare competitors to each other that report differently, you see? So how do we do it? We take the analysis amount, which is usually the current year, divided by the base amount, the oldest data we have. It's usually the prior year, typically. So current year divided by the prior year or base amount. I'm sorry, I'm thinking about horizontal. What I meant to say is we take the analysis amount divided by the base amount. The analysis amount could be any line item on the income statement or balance sheet, divided by the base amount of that balance sheet or income statement. The base amount for the balance sheet is total assets. The base amount for income statement is total revenue. So analysis amount divided by total assets times 100 for the balance sheet. For the income statement, it's the analysis amount divided by total revenue times 100 for the income statement. I'm going to show you the examples of both. So here we have. Remember, on the balance sheet, we express everything as total assets. So here we have the balance sheet. Coming down, we see total assets. Total assets divided by total assets is 100%. Okay? Total assets divided by total assets is 100%. So I take the analysis amount divided by total assets. Here we have cash, $48,844. That's the analysis amount. Divided by $338,516. I multiply that by 100 and I get 14.4%. I do that for every single line item for each year. The reason why we do this is to understand what percentage comes from total assets, right? It helps me to keep everything in spec, in scope, in line, right? You'll know when you've done this correctly when your total assets 100% equals total liabilities plus equity 100%. Because remember the accounting equation, assets equals liabilities plus equity. I go through the same process for the income statement. Remember, the income statement, everything is expressed as a percentage of total revenue. So I take the analysis amount, cost of goods sold, divided by total revenue. In this case, cost of goods sold 161,782 divided by 260,174 times 100 is 62.2%. I do that for every line item. Total operating expenses 34,462 divided by 260,174 times 100 is 13.2%. You see? The idea here is that it helps me to benchmark my performance against other companies. It also helps me to understand the percentage of where things are coming from. If I see it's too high, in my mind as a manager, I'm saying, well, that's a problem. I need to fix that, right? That's why we go through this analysis process. I had also mentioned that it's good to visualize things, especially for people who don't understand accounting and finance. Because people who don't understand accounting and finance, they're not going to understand what you're telling them. But horizontal analysis, visual, whatever's. I don't know any of that stuff. You show them a pie graph or a bar chart or whatever, then they get it. Some people are just visual that way, including myself at sometimes. So we talked about how to analyze using horizontal analysis. Then we talked about how to do the vertical analysis. Now let's talk about ratios. And that brings us back to the building blocks. We had mentioned that liquidity, as Ty had actually told us, liquidity is the idea of converting things into cash, right? Because cash is liquid, we know that. So we got liquidity ratios. We got solvency ratios. That's the company's ability to pay its debt. We got profitability, company ability to generate profit, and we got market, stock price, etc. Within these building blocks, we have ratios, and there's a lot of them, a lot of ratios. Now, if you all remember anything about Principles of Accounting 1, you remember that at the end of every single chapter, we had some ratios to figure out. Remember? Oh, man, I know. They used to drive you crazy. They used to drive me crazy. Ratios, I tell you. But why are they important? Because as a business owner or as a manager, y'all need to understand what's the financial health of the company. And you want to do that in a quick and easy way? Ratios is a way to do it. So let's take a look first at the liquidity and efficiency ratios. As we had mentioned, it's looking at how quickly we convert things into cash. Cash is liquid, right? So there's a couple of ratios that help us to understand this concept. Because really we're looking at our assets, cash. So you can see that all of these ratios in front of us have to do with our assets. The first is working capital. Working capital tells us our cash that we have in order to keep operating. In a simple way, our assets that we have to keep operating. So what's left over? Working capital. Inventory turnover, how quickly I'm selling through my inventory. Days sales uncollected, how quickly I'm collecting cash from my customers. Days sales in inventory, how long things are sitting on the shelf in inventory. Total asset turnover, how efficient I am at using my assets to generate revenue. Accounts receivable turnover, how quickly my customers are paying me. Asset test ratio and the current ratio. So we're going to go through all of these. Yep. First, working capital. Working capital is the amount of current assets minus current liabilities. It tells us about the company's ability to pay its debt and continue operating. It's what's left over, right? And we use what's left over to usually invest back into the company. So current assets minus current liabilities, that gives us the working capital. The current ratio. Current ratio tells us what's the company's ability to pay its current debt. Yeah? And so we take current assets divided by current liabilities to find the current ratio. The higher the current ratio suggests a strong ability to meet its current obligations. Yeah, anything above 1 is good in this situation. Anything below 1, somebody in trouble. Real quick story about that one. This ratio told me that Sears was going to be going out of business soon. Right? So before I invest in any company, or if I work for that company, or if I do any kind of business with that company and it's publicly traded, you best believe I look at these type of ratios. Why? Because I got to know. I'm not going to invest in a company that can't pay its current debt. Right? The bank needs to know this. Why? Because the bank ain't going to lend the company money if they can't even repay their current debt. Because that means they ain't going to get no interest out of them. See what I'm saying? So, just a little quick story about the current ratio. Asset test ratio. How quickly I can convert my assets into cash. Cash plus cash plus short-term investments plus current receivables divided by current liabilities. That's what that ratio is. Account receivable turnover. How many times a company can convert receivables into cash? How quickly my customers pay me? Net sales divided by average accounts receivable. In accounting, when you hear the word average, it usually means beginning balance plus ending balance divided by 2. That's average. Inventory turnover. How long the company holds its inventory before selling it. How long is sitting on the shelves. Okay. Cost of goods sold divided by average inventory. Beginning balance plus ending balance divided by 2 gives you your average. This ratio, if you work in retail, this is a good one to know. Because what does it tell you? Because if you do this ratio for all of your products, what does it tell you? It tells you if you need to lower the price of something because you ain't selling it that quick. It tells you if a product is no longer favorable by your customers. Yeah? Those are the type of information you can get from this type of ratio. Just saying. I've done it before. Days sales uncollected. Accounts receivable divided by sales times 365 tells us how frequently companies collecting its accounts receivable. Yeah. We want this number to be relatively lower. Yeah. Lower the better, honestly. So I want to collect my cash quick. Day sales and inventory. Ending inventory divided by cost of goods sold times 365. Ratio helps us to measure evaluating inventory liquidity. Oh yeah, that's a good one to know. Especially if you're having trouble selling some of your inventory. And the last one, in terms of efficiency, is called the total asset turnover. Net sales divided by average total assets. There's the word average again. Beginning balance plus ending balance divided by 2. Tells us company's ability to use its assets to generate revenue. Yes. How well am I using my property, plant, and equipment to help me to generate revenue? That's what this tells us. Okay, next batch is solvency. So we covered liquidity and efficiency. Now let's talk about solvency. Solvency, as I mentioned, company's ability to pay its debt. Company's ability to go out of business and be solvent. That's what solvency means. Company's ability to pay its debt. Nice and simple. Really, we're looking at long-term debt, but you get my point. So let's take a look at these 4. Debt ratio, equity ratio, debt to equity ratio, and times interest earned. I will tell you, if you've ever applied for a loan before, the bank ran these ratios on you. Okay? You took out a student loan, you took out a car loan, you took out a mortgage. If you've ever done those things, you applied for a credit card, the bank runs these ratios on you in order to figure out if you have the ability to pay them back. Yep. First one, we're going to look at 2 together. Debt to equity and equity ratio. Debt ratio and equity ratio. We're going to look at these 2 together. The debt ratio shows total liabilities as a percentage of total assets. The debt ratio shows us total liabilities as a percentage of total assets. Okay? And the equity ratio shows us total equity as a percentage of total assets. So here we have total liabilities, 248,028 divided by our total liabilities plus equity, 338,516. Gives me 73.3%. Then I do the same process for equity, 90,488 divided by 338,516 gets me 26.7. You'll notice that 73.3 plus 26.7 equals 100%. What this means to a company is that the company is structured using 73.3% debt and 26.7% equity. In other words, this company's operating a lot using debt. Now you might ask, is that good or is that bad? It depends. It depends on the company's overall operating structure. The company's financing itself, in this case, 73.3% of it is debt. 26.7 is equity. Personally, I think this is a little risky. Just a little bit. Is it doable? Yeah, of course it is. Is it risky? Yeah. Why is it risky? Company's 73.3% debt. It's a lot. I prefer equity. Why equity? Because as the owner of the business, I own the equity. Equity is what the owners own. You see? That's why I prefer equity. I don't have to pay somebody else. That's a liability. You see what I'm saying? That's why that one's important. So overall, what the bank does to determine whether you should get a loan or not, they run what's called the debt to equity ratio. They take your total liabilities divided by your total equity. And that gives them the debt to equity ratio. Here's the thing. If that's a high number, they ain't going to lend you more money. So that's why it's important to understand this ratio, yeah? Last of those four ratios is times interest earned. Times interest earned tells us about the company's ability to pay interest expense. If it has the ability to pay interest expenses, banks like that because that tells them that they can repay their loan in most cases. So we take income before interest expense and income taxes on the income statement divided by interest expense, also found on the income statement. Okay, so that is solvency ratios. The third area, as you recall, is profitability. This is the company's ability to generate a profit. We're covering our expenses, sales price minus our expenses, and as long as, what it costs to make it, and as long as that's true, then that product is profitable. The company is profitable when our income exceeds all of our expenses. We're profitable. Okay. Pretty straightforward. So there's four ratios we look at for this. Profit margin. This is real important. Return on total assets, return on equity, and gross margin ratio. Gross margin ratio we get from profit margin. So let me show you what all this looks like. The first one I'm going to show you is the gross margin ratio. Gross margin ratio, we take our sales minus cost of goods sold divided by sales. Sales minus cost of goods sold divided by sales. That gives me my gross margin ratio. Why is this important? Because it tells me the amount of profit I'm earning off of each sales dollar. Yeah? This is a really important one for you to understand. If you're pricing your product at the right price, the higher this number is, the better you're going to do with that product. Darius, I see your hand. Go for it.
Yeah, the cost of goods sold, is that also is the revenue, right?
Yeah, it's what comes after revenue. So we have our revenue, which is our sales. Then we subtract out cost of goods sold. Cost of goods sold is the amount it took us to make those products that we sold. Or in some cases, it's the purchase price of the product that we're selling. So for example,
manufacturing?
Yeah, exactly. So when we manufacture a product or make a product, there's three parts that go into it. There's materials, raw materials. There's labor, the people making the product, and the overhead that go into making that product. Those three things together make the total cost of a product. Some companies who make stuff, manufacturers, their cost of goods sold is the cost of manufacturing. If your company is buying stuff from a vendor and then selling it, okay, that's a retail business. And a retail business, their cost of goods sold is the amount they paid to the vendor for that product to then sell to the customer. That's cost of the goods sold. That's where the name comes from. So to answer your question, Darius, in a relatively simple way, here's my example. Macy's will sell a red T-shirt for $25. Macy's purchased that red t-shirt for $5 from their distributor. That $5 is the cost of goods sold for that shirt. So we take the $25 sale price minus cost of goods sold. That equals gross profit. You see what I'm saying? And then on the income statement after that would be all minus all the expenses equals net income. So the way we calculate the gross margin ratio is we take the net sales revenue minus cost of goods sold, that's just below revenue on the income statement, divided by sales, which is revenue again. That gets us our gross margin ratio. The higher this percentage, the better. That means in this example, 37.8% of every dollar I sold from revenue, 37.8% of that is profit, right? That's why it's a darn good ratio to know. Darius, hopefully that helps answer your question, to clarify it a little bit for you.
Yes, you did. Thank you.
Awesome. Thank you. Appreciate your question. Okay. The second ratio in this category is profit margin. Also an excellent measurement here to figure out the income from each sales dollar, the net income from each sales dollar. Okay, so we take net income, which is at the bottom of the the income statement. Net income at the bottom of the income statement divided by revenue, sales. That's at the top of the income statement. So net income divided by net sales gives us our profit margin. Our net income represented by each sales dollar. That's what this tells us. Also, really, really important ratio to know for running your business. Leland, go for it.
Oh, Professor, apologies if I don't want to get you sidetracked too much, but
It's
I was
okay.
wondering, since you're an accountant and you were doing books, that type of stuff, I was just wondering, as an investor and stuff like that, what would be like the ratios you would look at the most if you were a shareholder or a stockholder or something like that, and you were looking to invest? Like, what would be the ratios that make you want to jump or be cautious?
Yeah, great, awesome question, Leland. So there's a couple of them that I personally look at as an investor. One of those is going to be the current ratio. It tells me the company's ability to repay its current debt. For me, that's like number one, okay? Because if the company can't do that, they're in trouble, right? So I won't go near that company if that's not well above 1. Usually if it's like around 2, I'm cool with that. If it's like 1 point something, if it's like a low 1 point something, I'd be very cautious. And if it's at 1, probably won't invest. If it's below 1, I'm definitely not going to invest. So number 1 would be the current ratio. Number 2 would probably be profit margin ratio. Yeah, that one is also really important because I really got to understand if the company's generating enough sales to generate a solid profit. See what I'm saying? That's why like this type of ratio is really, really important. Like the profit margin, for example, net income divided by net sales. If this percentage that we're looking at right here is healthy, like 20% or higher, I'll probably invest. If it's lower, I'll probably be really cautious. And then I'll look at a couple of other ratios, but like those are probably the 2, maybe 3 most important ones I would look at.
Yeah, I feel like I had to ask because it's like 30 of them, and there was so many different ones. I was like,
Yeah.
okay, I figure out which ones.
There's tons of them, yeah. But
So many different ones. Okay,
there are.
thank you.
Yeah, absolutely. Great question. Yeah, and truthfully, when I talk to when I do consulting work for small businesses, I try to help the business owners to understand these ratios to a certain extent. Like I'm not going to go through all of them because honestly, not all of them are really that important. They are, they are for certain reasons, right? But I try to help them to understand them because as a small business owner, when you know what your profit margin is and you know what your um, current ratio is and debt to equity and all those things, super important because when that small business owner goes to take out a small business loan or maybe they're looking for a new investor, those are the kind of numbers they want to be able to talk about. So, I'll go in and I'll coach them on understanding these ratios. That's a good conversation. Next one is called the return on total assets. We take net income divided by average total assets. Remember, there's that word average again. Beginning balance plus ending balance divided by 2 gives you your average. So here we are, total assets, beginning balance plus total assets, ending balance divided by 2 gives me return on total assets. The other ways to find return on total assets, we take profit margin times total asset turnover will give me my return on total assets as well. So it's just kind of another way of doing the same exact thing. I prefer this formula here on top. It's a little easier. And the last one from this group is called the return on equity. Return on equity is net income divided by average total equity. Again, beginning balance plus ending balance divided by 2 to get the average. Helps the company to understand its ability to earn an income from common stockholders. I'll tell you that some investors, they like this one. And the reason for that is because usually with common shareholders, they're looking to get a return on that investment, a return on their share of stock. In other words, they're looking for a dividend payment. And so oftentimes they'll look at return on equity to figure out if the company will pay a dividend. For me, I don't care about dividends. A dividend is just a small check in the mail from your share of stock, and you get it on a regular basis. It's usually so small, it's like, I don't really care too much about that. I care about the value of the share. And as it goes up over time, when it gets to a certain point, I might sell it. That's where the real revenue comes in. You know what I'm saying? Leland, go for it.
Oh, so Professor, are you saying that people are just talking up return on equity like it's a big deal, but it's not? Is that what you're saying?
That's my opinion. That's my
Okay,
opinion.
thank you.
Yeah.
Yeah. Just
But yeah, that people talk about return on equity a lot from that perspective. They say, oh, return on equity, better percentage, they'll probably pay a better dividend. For me, I'm not a dividend investor. I don't care about the dividend. I care about the longevity of the company and I care about the stock performance. I don't care about the dividend. But it's still an important ratio, yeah. But some investors look at it from the perspective of, is the company going to pay a dividend in the future? If I was interested in that, I would look at these two ratios. These two ratios are really good for just investing in stocks and buying and selling them in a short term, playing the market, if you will. These two ratios are good for that. Okay, if you're that kind of investor, good for you, go for that. I'm a long-term investor, so these don't bother me so much. But let's talk about them. There's two of them, price earnings and dividend yield. Price earnings, we take the market price per share of common stock divided by earnings per share. This tells us the future growth expectations of that stock price. In other words, is the value of that stock going to go up over time? that would be the ratio we would compute to determine that. Again, if you're playing the stock market game, this is a good one for you. If you know short-term stuff. If you're doing long-term stuff, I wouldn't bother too much about this one. And the last one is called dividend yield. We take the annual cash dividends per share. Remember, dividends is what the company pays to their shareholders periodically for owning that piece of share, divided by the market price per share. This is used to compare dividend paying performance to different companies. Again, I'm not a dividend investor, so this, if you are, then this one's good for you. Anything above 1 is good. These next slide, 2 slides, 3 slides, 2 slides. This slide and the following are a summary of all of those ratios we just went through. So if you need a quick cheat sheet for the quiz, this is where you want to look. So, just so you know, try to keep your life easy and organized. 2 pages of ratios rather than flipping on through them all, you know. So we just went through a lot of information. We talked about how to analyze a company from horizontal analysis to vertical analysis, and then we covered a whole ton of ratios. Those are the 3 tools that we use to analyze the financial performance of a company. And, you know, oftentimes what we do is we want to summarize our findings to make it easy for the company to understand what's going on. You know, for the owner of the business or for the leadership of the business, I would prepare an executive summary for them, show them the analysis, horizontal, vertical, and ratios, and tell them, hey, you know, this is how your company's performing. I do all that in an executive summary. Executive summaries are usually like 1 to 2 page documents that just kind of show very short summary of the financial of the company. I'll also show them an overview of the analysis, how I went through it, what my methodology was, provide any evidence, show them any assumptions I made as I was going through the analysis, key factors, and then any inferences we can draw from the summary of the analysis. So that's just the kind of stuff that I would go through with a business owner or a board of directors or whatever. And then one of the last things I always talk about, you know, with all this type of analysis is sustainability. When we look at sustainability of a company, we're looking at the company's ability to keep operating, to sustain, to continue forward, to continue providing for the society, the investors, the people who work there, continuing operations. That's what I look at when we look at sustainability. You know, is the company doing the right thing for ESG, environmental, social governance, sustainability? Yeah. So all of these things impact net income. You know, that's why in accounting it's important we look at things like sustainability. And how do we find net income? Well, you all know it. It's your sales minus cost of goods sold equals gross profit minus all your expenses equals net income. From a sustainability perspective, we just group it a little bit differently. Okay, sales minus your operating expenses minus your taxes gets you income from continuing operations. Then we subtract out any discontinued segments to get net income. And below that, we calculate earnings per share. That's just from a sustainability factor. It's all the same stuff. It's just grouped a little bit differently. So that's, we made it. Okay, we talked about a lot of really important stuff today. And we talked about horizontal analysis, vertical analysis, ratio analysis. I showed you how it was all connected. I showed you the importance of why we do it. So we We did well. We did very well today. Yeah. Well, thank you, Leland, for sharing that with the class. Yeah. And I'm glad you did that because just so you're all aware, all of these lectures are recorded. I post them to both the classroom and to our YouTube channel. The idea is that if you ever miss any content, you want to go back and listen to it again, you want to further explore other topics, or if you're like Leland and you like to work ahead, you can even watch future lectures. You know, it's all there. It's all there. So thank you, Leland, for sharing that. In the classroom, what do we have to do for this week? And thank you for some of you for already starting us off the right way. You have 2 action items you have to complete for this week. Under week 2, we have the week 2 discussion board. Week 2 discussion board. Thank you, Lena. Thank you, Leland. Thank you, Nalisa, for getting us started. The 3 of you have posted. Your posts look very good. They're very full. You have references. You have, very well written statements. So thank you for that. When you reply, so your original post is due by Thursday night. I need you to also respond to 2 of your classmates, and your responses should also be, very full paragraphs, about 100 words per response. Do that by Sunday night. And so that way, it'll make for a really active and fun discussion. Yeah. So that's due this week. And then the other thing you have to do this week is the Chapter 17 quiz. With all quizzes in this course, you have 2 attempts. The higher of the 2 attempts is accepted in the grade book, okay? So I try to make your life easy. I do. That's, I care a lot about you and I want you to do well. So that's why we do these things. Yeah. Any questions, comments, or concerns about anything we talked about today or anything about the course? The textbook's working again, so that's good. Any comments, questions, concerns? Y'all good?
Yeah, we only meet. Are we meeting Thursday?
No.
Or is that okay? Just
No,
making sure.
we're good.
Okay.
Yeah, you use that Thursday class time to complete your coursework. Okay. So on Thursday, I want you to take care of that discussion board and take care of that quiz. And then you'll have a nice, easy weekend after that, right? So,
All right, sounds good, Professor.
Awesome.
Thanks.
no, thank you. I appreciate it. Thank you all so very much for your time today. I really appreciate you all being here. If you ever need anything, you need any help with anything, you can email me, call me, set up office hours. Email's the easiest. I respond right away, and I'm happy to help you. So thank you all again. I appreciate all of you. Have a wonderful rest of your night. Thank you so much. Take care.
Take
Bye-bye.
care, Professor. See you next week.
Thank you. Take care. Bye-bye.